Hi, Joe. Thanks for joining me today.
Hey Steve, what's up?
Well, what's up is another 75 basis point hike from the Fed. And the topic I wanted to cover with you is kind of revisiting a topic we've had. Um, but that's around some of the way Jerome Powell thinks about the labor market and inflation. In the recent statement released from the Fed, um, we have labor market continues to be out of balance with demand, substantially exceeding the supply of available workers. We've also got comments about fighting the wage spiral before it happens. There seems to be a real intent here to make sure that people lose their jobs and they don't see wage increases. But um, regarding what we've kind of said in the past about the Phillips curve and those relationships, what I'm going to kind of posit here is we're really kind of seeing monetary malpractice getting coming out of the Fed right now. That this is really disconnected from what really kind of makes sense. But I'm going to kind of throw that out there. Some of the focus on the labor market, and I think we kind of share the view that doesn't make a lot of sense.
Well, it's interesting, right? During the press conference, he actually said that he does not see wages as being a major factor in the current inflation. So he's already saying that, hey, wages are not the problem. But he seems to believe that they could become a problem. Why exactly he believes that, I'm not sure. But for whatever reason, we've talked about this a number of times. I find it in some ways just disgusting that he wants to put people out of work. I just don't understand why that's required to kill an inflation that he already acknowledges is not being caused by wages. It's caused by other things. So why doesn't he concentrate on the other things? Well, I think the answer to that is that, as the old saying goes, if your only tool is a hammer, you use it. Everything looks like a nail. Every problem looks like a nail. So he doesn't have the ability to increase oil production. He doesn't have the ability to increase, wheat exports out of Ukraine. He doesn't have the ability to do lots of things that are affecting some prices. And I want to be careful how we put that. Look, relative price changes are not inflation. So when we see energy and food prices, for instance, up, it could be that other prices are down. Now, we know that some goods prices are coming down. We see that in ISM. ISM manufacturing survey actually had a below 50 print on the price number. So that means companies were actually reporting price reductions. So we know that prices in some cases are coming down. They're just not, coming down in all cases. So look, I've talked about this before. I think that inflation has already peaked. So I think they're, just as they missed it on the way in, they're missing it on the way out too. They were way late to get started on this tightening process, and now they're way late again. They're going to go too far, or maybe they will. I don't know. I think it's interesting that really the message yesterday was that they're going to slow down. Which is, I've not liked this word pivot the entire time. There's this idea that you're going to pivot from rate hikes to rate cuts, and that's never the way this goes. And that really wasn't the right answer anyway. If you don't go too far, then you don't have to cut. Now, it's interesting. Today we look and we see the yield curve, for instance, the 10-year 3-month curve is back to flat. For a while this morning, actually, the 10-year was trading above the 3 months. So, that part of the curve had inverted very hard. And now because they're slowing down, that curve is uninverting. Another interesting piece of information is in the Eurodollar curve, which we saw just a little while ago. I was looking at the Eurodollar curve and the SFR curve too, futures. Prior to the meeting, the peak in rates was sometime between March and June. So you had the March contract trading at whatever price it was. I don't know the numbers off the top of my head. And then the June contract was trading at a higher price, implying a lower rate of interest. That's the way these things work. So now June is trading below March. So the peak rate, the date of peak rates has been pushed out. That's good news. I mean, think about it. We want to keep pushing the recession further away. We don't want to go into recession. By slowing down, they push that date out. That's good news. Now, look, Eurodollar market's volatile. It could change, tomorrow. We could be back to March or even move into an earlier part of the year. But right now, what happened yesterday and after yesterday is that the date for the peak in rates has been pushed out, which obviously implies that the date of any recession has been pushed out as well. It seems highly unlikely that you're going to start recession before rates peak. So I think that's good news. It gives us more leeway. It gives us more space between now and whenever that starts. And by the way, the date of peak rates doesn't necessarily imply that's when recession starts either. Recession might start sometime after that. So anyway, I thought it was an interesting press conference. I don't like Powell's focus on labor markets. I think it's misguided. But it is what we have. And it may be that they stumble into the right policy anyway, put it that way.
Yeah, and I think we're going to cover this a little bit separately because there might some of what we might be seeing is a break at the Fed where some of the folks other than Powell are starting to really raise some concerns. I think some legitimate concerns. But right now, I'm going to go back to my particular axe to grind. I really think Powell's gone too far, gone too fast. I think his focus on the labor markets makes absolutely no sense. It really does bother me to see these comments along the lines of, we don't want to really see wage increases, that we're worried about, not enough people unemployed. Comments, that we saw around the chances of a soft landing are getting reduced, and a kind of continued messaging from Powell that almost seems along the lines of, it very well may take a recession, and that's what I'm going to do to address inflation. But I think maybe there has been some softening at the Fed, but I think in regards to Powell, I'm still pretty disturbed by a lot of where his focus is, and a lot of what I hear coming from him.
Well, okay, let's unpack some of that. Let's think about this. This idea that you have to have a recession to kill the inflation. Is that really true? Now, I was talking to a friend of mine the other day about that. Obviously, someone in the business, because general friends don't sit around talking about the Fed. But anyway, we're thinking about that, and I said, "Well, do we have to have a recession to kill this inflation?" He said, "Yes, of course we do." And I said, "Well, why?" He said, "Well, because that's how it's always happened." In other words, every time you have a recession, it does reduce inflation. But does that mean that the only way you can reduce inflation is to have a recession? That's where I have an argument. I don't think that correlation is not causation. Okay, a recession will certainly kill inflation. There's no doubt about it. But as we found in the 60s and 70s, if you kill it and you don't kill the problem, you don't change the cause of the inflation, which in the 60s and 70s was kind of guns and butter kind of thing, or coming off of Bretton Woods and having the dollar collapse, all these different things that Fed, if you didn't fix those problems, then as soon as you took your foot off the brake, the inflation came right back. And I keep coming back to this idea that this inflation is a money supply issue. It was created by the combination of monetary and fiscal policy and a giant increase in M2. Now, M2 has declined on a month-over-month basis for a couple of months now, but you haven't destroyed that money that got created. It's still out there. It's sitting in checking accounts. It's sitting in savings accounts. It's in money markets. It's in CDs. It's built up over time too. It's not just from the COVID expansion. It's from the previous years too, where you had QE going on for a long time. I'll give you an example of that. The cash sitting out there, private equity firms have $1.4 trillion in what they call dry powder, which is cash. 1.4 trillion. And venture capital funds, they have about 400 billion in cash. That was built up before COVID. Now, some of it came in after COVID, I'm sure they've raised funds since then, but a lot of that was already there. And now we added all this other on top of it. The point being that I don't think you're going to be able to knock nominal GDP down really easily, because they're going to hike. They're going to hike rates to some point. And this goes to your issue of what you were talking about the pace, and why I think that was really important yesterday. The faster and farther they go up, the quicker they go up, they don't have time to see what the impact is. So they keep going up. Then they're going to really hurt the economy when the effect does come around, and then they're going to have to cut again. If instead they raise rates to a certain level and do it at a more measured pace, they'll be able to keep rates high for a longer period of time. And now, as Doug Terry was talking about in one of you guys' videos, that'll be able to trap some of that cash still sitting in the savings accounts and checking accounts and CDs and so forth, because people will be willing to sit on some cash because they can get paid for it. So I think that this emphasis on the labor market is misguided. I don't think that is a monetary issue. The lack of workers here is a demographic issue. It has nothing to do with monetary policy. This is about the dependency ratio. We've seen this. Working age population is shrinking relative to the old and the young. The over 65 population is growing rapidly. The under 16 population is not growing. But because you look at those two cohorts are essentially pure consumers. They don't produce anything. Now, maybe you could fix some of the over 65s by changing some of the Social Security rules. Should we be punishing people for collecting Social Security and working? Maybe we should take away that penalty. Maybe we could get a little bit more workforce participation on the older cohort. But there's lots of things we could do, but none of them have anything to do with monetary policy. So
yeah, and let me also hit on something you brought up, because I do think there's an ethical dimension to this, as well as I'm going to argue some big missteps were made here, and you go to the increase in the money supply, and you mentioned private equity. Well, I mean, most blue collar workers aren't making too much out of private equity. I mean, you get the wealth gap, you get monetary policy that really helped the people Hal hangs out with, the people at the very top. And now it seems that we've got an inflation problem. The determination has been made. We need to squeeze the people at the bottom in the middle. We created too much money supply. It grew too much. The wealthy got wealthier. We didn't really see too much of that get distributed. And now that we've got an inflation concern, the idea seems to be, well, we need a recession. We need to make sure there's no wage growth.
Well, look, this idea that monetary policy has an impact on inequality is not new. This is a phenomenon that was discussed way back even when you were on a gold standard, because what happened back in the day, so to speak, and we're talking 1700s, whatever, when you got an influx of gold, say, from the New World, you got inflation, but who benefited from that? Who benefited was who got the gold first, who got to spend it first, who got the money first. They were able to spend it before prices went up. Then it trickled out to everybody else because they spend the money into the economy. But by the time it gets to the guy at the bottom, the prices have already gone up. He's no better off. In fact, he may be worse off. So it's no different today. Okay, the mechanism is somewhat different because it's not a gold standard. But the fact is, if you create money, you know where it's going to end up first. It's not going to end up with poor people first. It's going to end up with rich people first. It's the old thing about, the banks are perfectly willing to lend to people that don't need it. So I think that, we did do a lot of that. A lot of this inequality that we have. And listen, inequality is an issue because you need some level of inequality, because you need that incentive to get to that next level. You need that in an economy. But it does get to a certain point where it gets to be too much. And it's too much because you end up with a political problem. That's where we are right now. Populism is a response to that inequality. On the left, it's Bernie Sanders. On the right, it's Donald Trump. But it's the same phenomenon. So, yeah, you're absolutely right, that inequality issue. So now, finally, the bottom end is getting a little piece here. We saw this stat the other day. I saw this stat the other day that the bottom quartile, if you break up incomes in the country by quartiles, the bottom quartile is the only one that's seen a rise in real wages over the last year. They finally got a little something out of this. And now what does Jerome Powell just wants to squash it? It's like, I'm sorry, but you need to look at where this inflation is coming from and fix that, and not concentrate on hurting the people who are finally getting a little bit of help. And by the way, higher interest rates are part of that. Part of the problem here is that people with savings and trying to save couldn't make anything on their savings. They had to go out and take all this risk, which they were ill prepared to take. They didn't understand what they were doing. They get involved in cryptocurrencies and NFTs and all these things, chasing and trying to catch up because they couldn't make any money on their savings. So, higher rates are part of that. I get it. And that has an impact on lots of people. First-time home buyers obviously are kind of in a jam here, with mortgage rates where they are. Which, by the way, speaking of inequality in banks and so forth, I've got to take a look at this. I don't know the exact numbers, but it occurs to me, it feels like anyway, that based on where the 10-year is and where the mortgage rate is, I think mortgage rates are trading at too big a premium to the 10-year. I think that spread between those two numbers has been narrower in the past. And I don't know the exact numbers. I got to look it up, but it's a feeling I have from thinking about the past, because I'm an old guy. I've had a mortgage since the 80s, or I had a mortgage in the 80s. So, I mean, it feels like that there's a bigger spread there between the 10-year and the mortgage rate, which makes me think that, the banks are taking advantage of the situation. They're trying to that in a way, the pace of rate hikes is having an impact there too. In other words, the banks are charging a higher mortgage rate because they're afraid that the 10-year rate's going to keep going up. And so they price ahead of that. They're getting ahead of the game, front running it, so to speak. And I suspect that if you can get rates to calm down, if the Fed would slow down, I think that spread might narrow too. And you might get mortgage rates to come down, even if the 10-year doesn't come down. I don't know. It's an interesting thing. I got to look up the numbers. We'll talk about it in one of our future talks, but I'm pretty sure that that's the case.
Sure. And just to kind of close up here, I mean, the little guy is getting squeezed a bit here, and maybe we'd be better off if the Fed didn't seem so determined to kill inflation by squeezing the little guy even more.
Yeah, well, like I said, I don't like this idea that you have to have recession to kill this inflation. I think there are other things we can do, and I wish the Fed would do them. Or somebody. It might be more a political issue than it is a monetary issue, put it that way.